All in today, 36 contracts were terminated, 165 million. I don't know. I think that was like this one. You see? So they
Yeah.
like put it's like keeps a tally going of what's been done. This is what's at least been reported. Who knows what actually like.
Yeah. So what's the 2 trillion goal? Why is that the goal?
I think that's what they were talking about. Cutting expenses by 2 trillion, which is, I mean, dude, that's not gonna happen.
Yeah, I mean, like, isn't most of it like social security and that kind of stuff? Like, you can't
Yeah,
really.
dude. No, there's no way. There's no way. Like if you're gonna cut it like that, man, you're gonna have to take down defense. You're gonna have to take down Social Security, healthcare. Which, I mean, there are cost savings in there for sure, but I, t- I don't know about getting to 2 trillion. But like the idea here is that there's aggressive cost cutting going around. So
Yeah.
it should offset. That's a funny thing, right? So like about 12, what are we? We're in about 6 to 8 months ago, right in the summer. Um, Everyone was so concerned about the uh, the deficit running away and like the defaults and all that stuff, right? And everyone was saying like, oh yeah, this guy Trump is gonna blow out the deficit. He's gonna destroy. You know what I'm saying? Like
Yeah.
he's gonna bring us into more further times of fiscal instability.
Well, we were the
And
ones that were against that because he was actually very good for the deficit until COVID hit.
absolutely, yeah. I mean, he was running like a 3% deficit, right? So 3 to 4% deficit in that range when he was president. Um, and I think that like you know you're in a situation now where the deficit far exceeded what it should have in an area where there was no recession, right? So like we were faced with deficit style or recessionary style deficits when there was no recession. And in some weird way, I think that's what stopped the recession from actually happening in 2022. That and there was just a, a lot of like inelasticity in the market from COVID, the supply chain shocks, and then you had inflation, and I just think there was a shortage of goods. So like people still had money from this COVID run, and the money was still flowing around, and you kind of saw like the first real slowdown since COVID, and everyone was just in animal mode, animal spirit mode, and you had Mag 7 names dropping 20% on earnings. So like that was just I think air coming out of the market, and the market kind of went from pricing in the mega bull run to just saying like, okay, time for a recession. And we saw growth figures come in. Growth expectations were down in the dumps, obviously with the market, but then we actually saw the official GDP numbers come in, and it ultimately put in a situation where the market priced in a recession that never came, and we were close on the GDP figures, but there were some distortions in there from imports and whatnot. So we never actually got the official like um the demand, the growth demand in the private sector never went negative far enough to put the economy into a real recession, but the stock market front ran that, right?
Yeah.
Like we always say, the market's going to front run everything.
Well, doesn't it feel
So
like now the market is not expecting a recession at all, but we have these budget cuts, which obviously, and even the tariffs obviously are going to have a negative effect on growth when our system is already showing growth slowing and nobody's talking about a recession? Don't you think this is kind of the perfect environment for a recession to hit?
yeah, obviously recession odds are in the toilet, right? So we're talking like, 20% range recession odds or something like that. When this happened in 22, we were at like 75%. So the market was pretty much baking in that recession, like I said. Never came. Now, yeah, I do think that like I'm not a recessionista though, so like I'm never gonna sit here and be like, yeah, like let's position for the recession. Our models are gonna do the heavy lifting for us. I never use recession as a base case. Um, I think the main reason for it, man, is like they don't happen enough. They actually don't happen enough for you to be so quick to anchor into one, right? Like to say like, oh, recession's coming. Like if you really look at and like forget the official metrics, but even just deep slowdowns, they don't happen often either. Slowdowns, however, they do come more frequently. So I think that we have to be positioned first. The base case is to slow down, as the system's been saying. And if that slowdown progresses to a recession, if it does, then we'll be positioned for it, right? We'll move we'll move our chips around the table as the data comes in. But to sit here and scream that recession is on the way, I think that's ill advised.
Yeah. Yeah, I mean it definitely should not be the base case. But let's take a look at Bitcoin. Like we've got quite a bit of a sell-off in Bitcoin. We had that wick down to Momo. I think the slowdown is definitely taking its toll on Bitcoin right now. And I don't know if we're really going to be breaking up to new highs until we do get that risk on regime, which we are kind of flirting with every so often. We had a couple of risk on days, which brought us closer to risk on, but we're still in a slowdown regime. And I think that's really hurting Bitcoin at the moment.
Yeah, so obviously this Bitcoin price action is garbage, but it's not like outright bearish, right? We're not really feeling pain in Bitcoin. It's just like annoying, right? It's annoying and it's garbage in an annoying way, not
Yeah.
in like a
It's
painful
just
way.
another thing that's pointing towards the system being right in telling us that it's a slowdown. It's just confirming that. And we're even seeing healthcare and utilities grinding higher while equities are still chopping. They were up this week, but we'll see if that continues. But over the
I
last
mean,
like month, utilities and healthcare have been outperforming the Nasdaq.
we pretty much positioned for the slowdown on the 24th. So of December, right? We moved some risk around. We're not fully positioned for the slowdown. I don't want to jump the gun there, but the Nasdaq has gone nowhere since then, pretty much,
Yeah.
with a lot of volatility in between. Now, I think that there's some interesting things going on here, right? Like miraculously, our system front runs a slowdown when Trump gets into office. Everyone's got animal spirits when he comes into the office. Everyone's thinking that this is the new bull run. Um, there is, I don't want to say it's euphoric, but there's this sense of almost like guaranteed gains. Like, I guess the way to put it is there's this vibe that's going around that's like, okay, Trump's back in 2016, 2017, 2018 were good years, ex-COVID, right? Maybe that one, the Fed scare in 19 or 18, 19. Outside of that, like the market was overall up and to the right. So everyone's like, okay, this is just a playbook repeat. And it could very well be that, but I almost feel like people are taking this environment as a for granted situation, like Trump's in, we're going to print type of thing. Like it's not so
Yeah.
much like, okay, Trump's going to support the economy, most likely. Trump's going to be pro business, pro growth. There should be positive upsides here. It's more like I feel like the vibe is like we're almost promised or we're entitled to a mega bull market. And we could get one. We could flip back to risk on real quick and just rip. But I also think that there's like some consensus, like the cake's kind of baked. Like I don't want, like again, I'm not calling no recession. I'm not saying that. I'm just saying when you look at it from expectation of like earnings, like you have this DeepSeek stuff that came out in the last like couple of weeks. Total bullshit, right? Like
Yeah.
from the drop, like total nonsense. But what it did do and what you saw was like, just look at Nvidia, right? Like Nvidia like still has not recovered. And, it's trying, it could very well recover. But I think there's this ultimate fear, and Nvidia is the Mag 7 name that's down the worst right now, but I think there's this ultimate fear that like these companies, they ramped up so much capex, these Mag 7 names, And you kind of saw this like with the Qs back in early last year. Everyone's like, "Oh, it's just 7 stocks. It's just 5 stocks. It's just, Nvidia. It's just this," and right? But those were the companies that were basically front running the race of artificial intelligence, right? They were the ones that were moving the most. And I think that there was this whole like big rush to the upside or race in for this capex, like all this entire like drive from capex. So like think of it like this, right? So capex is just capital expenditures, right? So what's happening is these companies are investing a lot of money into AI. So the original hype was like, okay, these companies are getting positioned. They're going to be the leaders. They're the ones with the ability to spend all this money and still be okay. And that's where the initial allocation drive was from, where everyone chased the Mag 7 names. And now you're sitting in a position where it's like, at some point, we kind of have to figure out how that capex comes back as a return. And
Mm.
this just happens to coincide, right, with Trump coming into office. So there's a lot of things going on here. So now these companies have to make their money back on their investments, right? So they have to like try and pull an ROI. And some of them can, some of them are going to have trouble doing that. And I think we're at the stage, at least based on what our system is showing us, the feeling I get from looking at the market where everyone's like hyper bullish, that like we could be faced with just like an annoying slowdown. Maybe it's a quarter, maybe it's 2, maybe it's all year, maybe it's only the next like 6 weeks. I don't know, but we are in a slowdown right now, and I just feel like it kind of makes sense. I mean, let's just be honest here, right? Like let's just like just let's look at this.
I
You
mean,
think
when you
we're
put it
we
that way.
I mean, like, I'm not this is not to be bearish. I hope we can get back to risk on, and if we did, I'd long right up here. Don't care. System is the system, the models are the models, they will guide, right? Like, that's how we operate. There's no like, "Oh, well, the price is high, can't go high, but
Yeah.
can't go higher."
But
But let's just
you also have to put into consideration inflation doesn't have the upside pressure that it used to have. Like we are at risk of disinflation as well, which inflation at the end of the day pushes stocks higher. It pushes all asset values higher. And right now we don't have that upward pressure, at least not nearly as much as we used to. And I think that's going to come into play as well. And I think the market knows that.
yeah, that's true. And I just think from a perspective of like this, right? Like, you look at it from where we've gone. And bull markets go up. There's no reason for you to be bearish at all in a bullish trend. The trend's still bullish. The market should still go up. But like, there's always these periods of like just digestion. Like, look at this right here. We haven't gone any. The Nasdaq has not been a new high since December. It's almost been 2 months. This might be like the perfect consolidation, and we can finally break up and go. That would be nice to see. But like, I do want to say that in a slowdown, it's very, very hard. It's not very frequently that you get just massive runs in risk. It's just like everyone is almost like trained, I think, to like the last 2 years plus like Trump coming back into office. There's this expectation that like if you buy today, in 6 months, you're almost guaranteed to be up. And that could be tested. And we got to be ready for that. I hope it. I hope that, again, my favorite regime is risk on. I love just taking my account and full porting leverage right into the Nasdaq and just riding the wave, man. That's just nothing better than
Yeah,
that.
that's the
Nothing
best.
beats that.
Yeah.
Nothing beats that. But you got to be careful, because if you're not ready and you get like blindsided, you could blow yourself up. And that's why like the rules are so important. I would assume that this holding period we've had here, with just like getting ready to move into the slowdown, has got a lot of people annoyed, especially after just like the last 2 years. Like, the idea of like having some money in cash, or having some of your NAV in cash, just, I don't think sits well with some people. I don't know everyone, obviously. I don't know anyone's situation, but I get it. I mean, like, just look at the market and like, today, for example, right? Palantir is making headlines. Stock is, trading at 100x sales. absolute monster. Would I short this up? Do I think it's overpriced? 100%. I 100x sales? Like, come on, right? Would I short this? Absolutely not. I'm not retarded. So it's like, you know, like it's one hand washes the other type of thing. Like you have to understand where your edge is. Like in my opinion, my edge is not buying Palantir at 111. It's waiting for the next signal in RQF, right? Now some people might say like, oh, it was expensive at 111. It was also expensive at 70. It was also expensive at 50. Like, what's to say it's not going to go to 150? And you could be right. You could make, 20, 30, 40% from here. It's possible. The stock market, anything's possible. But like, I just don't look at this like the same edge that I have in RQF. So when I look at something like this, like that's up the way it is, right? You have to look at this and say, this is not the only stock. This is a very prominent one at the moment, but there's a bunch of stocks that just have gone haywire, right? First, it was Nvidia last year. Palantir's a leader right now, and I mean, you just saw Meta go vertical, right? Like in the last couple of days. I mean, last week or two, Meta goes up 15%, right?
Yeah.
Stocks are doing good.
The thing that makes me okay with being in cash when it's time to be in cash is I just know when we get into a position and we're long triple leverage, whatever we're long, whether it's utilities, the NASDAQ, healthcare, doesn't matter. It's with leverage. So any potential missed moves get quickly caught up with leverage. So that's what helps me staying in cash. It's whatever, yeah, I'm missing some moves here and there. There's always opportunity in the markets, but when we're long with triple leverage, and we just make back whatever we lost. It's not like we're not holding the SPY and then we underperform the SPY and then we buy the SPY and then we match the SPY's performance. It's like when we buy with leverage. So it really doesn't matter to me that we're in cash for a while. It did matter when we were in that huge slowdown, stagflation, whatever that was in 2022 for like a year holding cash. That was pretty rough. So I'm really hoping we don't get another one of those, but a few months here and there, I'm okay with that.
Yeah, I mean, also just remember, so the 2022 scare, I think like the big risk here, or the caveat of something bad happening, would be bearish trend equities. Without equities becoming bearish trend, I don't think you get the recession.
Yeah.
So
or
like
the fake recession like in 2022.
Yeah. So like if you're looking at this from like a more like simple perspective, like a scenario, B scenario thing, like NASDAQ over 500, you have no recession. NASDAQ below 500, start getting worried.
Yeah.
That's the way I would.
Well, also a scenario, like we're in a scenario right now that's a lot different than in 2022. Like the Fed is extremely restrictive. If we do get the market pricing in a recession, it's not going to be an inflationary recession like we saw. Like if the market starts pricing in a recession, there's going to be opportunity in bonds because that's going to be a deflationary recession.
I mean, look at crude, man. Look at crude.
Oh, yeah. Like we definitely have some disinflation risks.
Yeah, like even commodities as a whole, right? So this is all I want to touch on this. So like again, the last month and a half, I'm sitting here just pounding the table. Like tariffs are not the type of inflationary pressure everyone's expecting them to be. I mean, like right now, the biggest thing in the media is eggs. And yeah, there's an avian flu going around, right? That's affecting egg prices. But like everyone's like, oh, inflation's coming back. Egg prices are coming back, like inflation. And everyone's like, Trump's tariffs, inflation, prices are going up. And like, that's not how this works, right? Because unless you're changing the supply of money or the access to capital or the access to money, right? If you're not altering that, what you're essentially doing is rerouting demand. So like, if everyone makes $100 and that doesn't change, everyone still has their $100 that they make, but the price of A goods goes up, then they're going to have less, and they have to buy the A goods. They're going to have less money for the B goods. So demand just gets shifted around.
Yeah.
Now, if you start increasing the money supply, then people can have access, will have access of or capital access to both goods, therefore pushing up prices. Now, like the tariffs are pretty simple, in my opinion, the way that this works. They are going to create short-term price shocks, and those price shocks are going to be combated with um, inverse price moves somewhere else, or inverse um, or demand retracements in other areas. And I think that's where we are right now. Like, you're going to see some noise and inflation, and so, to be honest with you, I think we already kind of saw that. We spoke about this last week. I think like this move in inflation, we'll see where we end up in this month for the month of January, but like going forward, I think we kind of front ran a lot of these inflation fears from, September lows to where we're going to be now. I, it makes sense. Like, I think that the market kind of got scared as Trump picked up in the polls, and like they realized, okay, this guy's gonna be the next president, and we know he's a tariff guy. So like we have to pretty much front run the tariffs, and that's gonna, again, remember, like I just said, there's no change in money, right, or minimal change in money, but now demand's accelerating because there's the fear that prices are going to go up.
Mm. So
In
what we
turn,
just saw is the market pricing in that short-term price increase, and now we're kind of getting into the future disinflationary pricing now.
yeah, like for perspective here. Now this is early, right, in the process, but February CPI from Cleveland Fed is priced to be 2.62. To give you an idea of where that is, that 2.62 is right here. Okay, so we'll make this like pink so people can see it. Purple, make it purple. So this is where Cleveland Fed has inflation rate for February. Now, obviously, that we're only 6 days in, so we got some time there. But the January expectations, which are going to come out in the next week or next week and a half, are expected to be 2.85. So even though that print, the next two prints, and I should say this, the following print that's coming up and the print thereafter, which we'll get next month, are both expected to be lower than where we are today. Now, could that change? Yeah, maybe it's a little bit of a shock. Maybe this print's a little hotter. Maybe it comes in line at 2.9 from the or meeting the prior, not in line, right? So it comes in at the prior, so not as disinflationary. Either way, I just think that like you look at it from a commodities perspective, and you could just see like we're still below the 2023 highs. Like commodities have gone nowhere, and you have that slow in rent, right? That's hooking up too in the background. That slowdown in rents. So I'm just curious to see how like I almost feel like, as stupid as this is, like we've moved with this tariff stuff. Like we've priced in a lot of inflation fear up front, but we actually have more like downside disinflationary risk than many people probably think at the moment.
Yeah.
Maybe that comes into better balance in the next couple of months, but
I think people are
just
still kind of just shell shocked from that inflation that we had just this whole time. And so they just think that it's a higher risk than it really is. But I think where the Fed is at right now, and even with Trump in office, I think inflation risks are next to none.
right. So like we're like look at this, right? So let's just take a quick look at EFFR, and we're gonna look at the EFFR versus the 2-year, right? So what this is for those that are listening, it's the spread between the treasury, the Fed funds rate, and the 2-year. So right now the 2-year is trading at a slight discount, right? So it's trading at 11 basis point discount to the Fed funds rate. I think that realistically, we're going to be in a situation where this can very easily trade back down, trade higher. So like what I mean by that, simply put, the 2-year can drop. The 2-year is basically back to like when the Fed like was hiking, but it's not in negative territory yet, which would imply that like the Fed is going to hike some more, right? So like we've sucked all the cuts out of the market essentially.
Mm-hmm.
And we're now going to go into a position where you have this macro slowdown that's lined up, right? Based on our system. At least it seems like it's pretty strong right now. You have Trump coming in to like wind down these deficits. And if he can do it, we'll see. And you also just have this overall reallocation in the large cap tech market. It seems like we're starting to see like more of like the equal weight like RSP, like the like some of not RSP specifically, but the other 493 stocks come back. You know what I'm saying? Like a rotation. Like if you look at mags, right? Look at mags. It's been going sideways since December 17th. Okay. No new highs on the Mag 7 since December
So
17th.
capital is
But then
just
you look
rotating. What about IWM?
but you look at SPY. SPY made a new all-time high like 2 weeks ago or a week and a half ago. You see?
Yeah.
So like you're starting to see some of that capital rotate out. I mean, IWM is this is a dog of a dog. Man, come on. Like I like the level of underperformance in small caps. Like you almost like feel bad for the small cap investor, and you're like, there's got to be a bull run in here somewhere. Like, dude, just look at it like this. Okay, since 2021, they've pretty much gone nowhere with dividend reinvestments. Like we're talking like we're still not above the 2021 peak on small caps.
Yeah, it's rough.
Like look at the Nasdaq for the 2021 peak. So just like ballpark estimate, we're up like 32%, 33%. So it's obviously just rough out there for the small cap bros. And I get it. Like I've been saying this for a while. It's the interest rates are your enemy here. It's like, it doesn't matter if inflation comes down, the rates need to come down because all that really happens is if inflation keeps falling and the rates don't, like you're just adding further restrictiveness to the economy. And even if the economy is okay, it's just going to be harder and harder for these smaller cap names to outperform. But let's wrap it up here, guys. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.